Okay, so everyone's here, ready to go? Okay. Welcome to Share Club. Share Club is one of the amazing benefits of working at Simply Wall Street. Every 2 weeks, we get together and we just discuss investing. So Share Club is not a service, it's part of working here. It's more about learning and just having fun and being social. So anyone watching this, please do not take this as stock recommendations. It's all about improving ourselves as investors. And actually, if you go to the next slide, Emma, you'll see a nice big disclaimer, which I highly recommend reading. So today we have a really exciting presentation from Quan. I'll let him introduce it. So save your questions for the end, and let's get into it.
All right, guys. So yeah, I thought it'd be interesting to introduce you guys to this company because I've been pretty excited about them. I knew this company for a couple of years. I believe I discovered this company since a couple of years ago when it started, just through TechCrunch or something like that. But obviously they wasn't public. And yeah, just the way they run the business and the way they redesign the insurance process made me really interested in them. Yeah, so first thing first, let's start with this. I'm totally a beginner in investing and only started to learn about investing in 2017. And then that's when I downloaded the app and I got a chance to work with Simply Wall Street in 2018. But before that, I bought my first stock in 2018. I have no financial background whatsoever, but math is okay because I'm Vietnamese, you know, most Vietnamese are okay with math, or they probably would fail year 12. At this time last year, I didn't even know the meaning of fair value. But because I was at Simply Wall Street, I had all the tools and resources to learn investing quickly. And also I have a master outweigh. Also, whatever I present today is only what I've learned to now. So instead of presenting a sure bet, which I'm not sure myself either, I'll just take you through my process of researching this stock. And this one is the riskiest one in my portfolio at the moment. So I'm holding it. Hopefully you can let me know if I miss anything and I should sell it to buy Tesla at $2,000 or not. And also, same with Michael, and I need to invest within my area of competence. And obviously I need to use my life skill, design, branding, marketing, UX. So it's essentially assessing the desirability of the product and whether people would want it or not. So I tend to invest in products or services with the business model that I can understand. And most of them has a really simple product with a constant price point for their product and make it easier for me to understand how much it can scale. And I enjoy discovering new ways to solve old problems. So I invest in the new stuff. Like I like to look at new technology and how people solve old problems. And I focus on the long term. We talk about that in a bit, but what I'm not so good at is ETF. I don't know how to analyze a group of stocks. I don't know how the market will go up or down, or the economy will go up or down in a certain amount of time. But I sort of know if a company can sustain over certain difficulty in the economy. Commodity or mining, it's hard to actually price static asset. Like I don't know if that certain thing can have a higher price or lower price. It's really hard, and we don't know how much they store in their basement either, so who knows. And yes, and cyclical and turnaround businesses is also very hard to understand. And my process to research interesting companies, a company that have different and new. First step for me is validating proof of their concept, whether they have the product market fit, people want it, they have a market for it, can they scale? Next, I look at supply and demand, whether the supply, they have the increasing demand and whether they can supply to that demand or not. And what is their unfair advantage? The next one would be so doing the due diligence of looking into the financial, see if they have debt or not, or whatever it is. Management looking at whether I can trust these guys to run the company, and are they reliable? Will they exit soon? Business strategy. They have a plan to grow this company. Usually, they all try to say they have a plan, but is that plan real? Is the main question. I look at the risk that potentially can happen to this business that might be out of their control. Estimating future return. This is where it comes down to valuation. Estimate the reward, like what is the risk there? Is the reward outperform the risk? And any chance of me going down to zero? Is the current price safe to pay for over the long term? So yeah, now it comes to the stuff. When life gives you lemon, you make lemonade. Thanks Sam for the gift. And so this company is pretty interesting. They kind of take insurance industry as a vertical and looking at the new way to make people buy the product. So especially this is basically the statement from their website, and they currently only provide renters insurance and homeowners insurance to the United States market and a couple of other markets like Germany and Netherlands. And what they do, they use artificial intelligence and behavioral economics to replace the brokers and the old process of doing insurance business, replacing most of the manual paperwork and making sure they optimize everything to the maximum. And they also donate a certain amount of their profit to charities. This one here, just to introduce you guys to their chatbot, which is called Maya. And Maya is basically, so if you want to get insurance, you download the app, you talk to Maya, and you get a quote. It usually happens within 3 minutes. And I actually went through, look at their process, and it looks really, really good. And it's extremely well designed. The experience, you can't complain anything about the experience so far. And which anyone can get a quote for within 3 minutes. That's really efficient instead of calling a company or filling in a form for like 20 questions or something like that on an insurance website. Loss ratio at the moment is 300%. If someone's not familiar with the insurance industry, loss ratio is essentially the amount of money that they have to pay out for claims. That was in 2017, and so that means every dollar that they take in as a premium, they have to pay 300% out, and that was because the bot wasn't good enough, and it's giving quote at too low comparing to the actual to what they take in, and obviously that has improved over time to 70%, and they also charge a fixed fee, and this fee is obviously recurring. So there's something similar between software business and insurance business, which is the recurring revenue part. But the only difference with insurance and software is that they have to save that certain amount of their revenue to pay claims. These guys also donate excess premium to customer charity of choice. They automate most of the setup and claim processes. And this is the interesting part. I think the transparency and fixed cost model addresses the key pain point of hunting for cheap insurance. Is nobody knows what they are paying for and how much they're supposed to pay for. They're supposed to pay for the product. And you can't go to one company and the other company. They give you quotes and you don't know what exactly you're paying for. All the fine prints are hidden, and yeah, so they try to acquire customer between one to the other by just telling them that you can change insurance and save, and that's basically a marketing tactic to get you to come from one company to the other, and they give you a discount up front, and that's premium kind of going up over time or not. It depends on how long they're going to pay for that difference. And the product here is the delivery of the policies. It's not the policies. Lemonade uses reinsurance as a strategy to de-risk. This is also interesting. Reinsurance means that they actually use the certain amount of they take 20%, 25% as the fixed fee. 75% of that premium they will pay to another insurance company. It could be like a much bigger insurance company to take 75% of the risk for them. And with this model, they kind of de-risk a lot of the fluctuation of their business, and they can maintain a certain amount of constant revenue coming into the business. Also, they don't have to keep a massive amount of premium to pay claims, and this will help them keep that cash flow to use to improve the business instead of paying claims. And the most important thing is, do customers love their product? And to me, this is really important because this allows the product to scale, whether people spread the words to other people. And millennial, like social media. What's interesting here is if you look at App Store, which is one of the channels that's really difficult to buy. You can ask, well, we experienced that. You have rating and reviews on Apple's App Store as 4.9% from 35,000 ratings, and that is very tricky to get. Most of the rating channels, you can probably game it a little bit, and I know exactly how to do that. But for these two channels, the Google App Store and Apple App Store, it's very difficult to game. Also, you have something like Twitter with these guys. They really active on social media, and you can see a bunch of different comments about their service. Some of them actually go to Twitter to complain about certain things, but mostly around why they can't get this price, or the premium is too high. And then and Lemonade is extremely active on social, and they respond to every single comments there. Like this one is also interesting because this guy basically just had a good comment, and he said that he's get insurance for his pet, and which is like the new product that they just released when they went IPO. And the Lemonade just asked him to send the picture of the cat, and he responded back, which is pretty interesting. And I think the most important thing for a product to scale, and especially new product, is pricing, and whether it's cheaper and more efficient than the old model. And I went to look for some of the reviews, and obviously Lemonade is the cheapest possible that you can get. And obviously that's based on the scale. Not everyone can get this cheap rate. This is like the average rate for the business. For their pricing. And also there's something interesting here is one of the review that I found, and this is not the review from the user, but from professional reviews, that like a comparison website. And what they say in here is the disadvantage of using Lemonade is you give up access to some of the extra features like specialized coverage and in-person customer support. And to me, this is a great feature of the business. And so next, I need to try to think about like trying to clarify in my head what is their unfair advantage. And what I found so far is they have an integrated AI as their core value. So they invest in machine learning, which is the reason why they went for IPO, to actually improving their deep tech. And I think they managed to hire some of the head of engineer at Spotify to help them with machine learning, integrated data. So instead of with the other insurance business, I have a friend who actually works for a software company that provides software for insurance businesses. And what's interesting is most of the software as a competitive landscape, they only provide a workflow optimization software, which help them between the sign up and the claim process, and mostly focusing on the claim process, how to optimize that process. But the fact that they have to do that and using external software to do that is a massive inefficiency for these companies. And with Lemonade, their advantage here is they have a single source of data, and this data can be leverage to optimize marketing sales claims. And all these, it is working in a cycle that it can continue using data from marketing to optimize their sales. And then, yeah, that cycle will go on. They own the entire data infrastructure. And automation at the core of their business is, yeah, exactly as I said, everything is optimized. When a user lodge claim, when a customer lodge claim, they also get this guy to talk to the camera for a couple of seconds and tell their stories. And they use facial expression recognition and AI to detect if people are lying. And obviously this bot, which is called Jim. So Jim is a different bot than different bot from Maya. And this bot settled about 30% of the claims immediately in a matter of seconds. And yeah, so they pay customer really fast. And also when the claim is not paid immediately, most of the information and data has been aggregated to the claim officer, and this guy can just pick up and handle really good. And from what I saw from the reviews, they've done it really well, and really efficient as well. Back office processes, most of this is obviously optimized. And another important thing is the network effect here, brand and marketing. These guys are really, really good at marketing, and that's why I try not to show some of the sources that they have. Like if you watch the video, you probably I'm trying to not be too biased to their brand and to the charisma of this CEO, because this guy is really good at talking up his business, right? And so, but the brand, it has a really strong effect. So like a good brand name is something that is familiar but new. And also the concept of lemonade, as I introduced it above, like when life gives you lemon, you get lemonade. And it's backed in the brand itself, and I think that is it's a really smart branding. And also they have really clear transparency on the brand, which is a good value over the long term. Social and community management, it is something that they really strong at, and they manage every single channel very effectively. Customer service is also very good. Like if you saw on the tweet above, they just respond to every single one of them, and they address problem really quick to keep their rating at like maximum. The scale engine, this is an interesting part. So Lemonade donate their unclaimed money to non-profits, and also the other side is they reduce risk with reinsurance, as mentioned before. So basically they take 25% here, flat fee, and the 75% they would keep that as to pay claims and pay for reinsurance. And over here, if there's any excess claim at the end of the year, they will give back to non-profits. And this is up to 40% of the excess claims, by the way, so to be exact. And over the years, they have donated quite a bit of money. And also they give the user the ability to choose some of the charities that are on the list. Depends on what they feel strongly about, which is pretty good. And by introducing this third party into the relationship, which is the charity, they change the behavioral economic toward the product and created a very unique network effect here. Some of the people who use it, like a lot of customers here are suddenly proud of buying insurance, which is a bit strange. And some of them, they might have like an incident, they made claim, and then suddenly they found that someone lost a laptop or something like that in their house, and they found a laptop, and then they contacted this guy, say that I can return the premium back to you because you should be using that money for charity, which is an interesting story. I don't know how real that is, but it's still an interesting effect from changing the business model. Next thing is, can they attract talent? And yeah, I'm sure they can, because this review phenomenal. Well, if someone can tell me, maybe even can tell me whether they can game it, I'm happy to hear. It's like how you asked me to race in Wall Street. competitors, I looked at some of the competitors, and the best place to find this competitor is Seeking Alpha, because there's always a bear case. Someone would say that, you know, because of this, that, competitors, blah, blah, blah. And that's when they list out all the competitors, and you don't have to go too deep digging for all of them. And yeah, some of the, on the right-hand side here is all the old school. And obviously you can tell from the way they approach their branding, everything is the old process, and all they're trying to, they just apply new marketings and new coats of paints on the product and keep selling to their market. And there's some of the new school product, which is quite interesting. But this one, these guys basically the same model. They just optimize it with like with a new, fresh approach that appeal more to millennial. But I would also still consider these guys as very strong competitor, at least in the short term, until LMND gets a stronger network effect over the next couple of years. So yeah, next thing is this is the boring part when I start to check. So after validating the whether this business can scale and it has demand and supply, I look at the numbers, and just to make sure that all these are legit, not just the story itself. And obviously, look at Simply Wall Street, you won't be able to see much with these growth companies, because when you look at the chart, it's like, oh my god. But then when you kind of need to go into their report, and that's usually what I do. I probably pull up one of their recent quarterly report or annual report, and just at least go through them and to see how they're going. And yeah, so this is only a quarterly report. I couldn't find a full year-end report because this company just IPO. And yeah, so they managed to double the growth revenue over the last year for comparing to the same quarter in the previous year. And what's interesting here is also they also managed to grow their profit margin from 12% to 18%, gross profit margin from 12% to 18%. And this is basically from optimizing efficiency on the AI, from optimized quoting and optimize all the claim that they currently that's coming in. Well, when you look at the balance sheet here, and I usually use Simply Wall Street for this because it's really good. And what you see here is like there's a massive amount portion of liabilities, and this is when I need to come in and have a look to see what they are. So what's interesting in here is you have a line here called unearned premium, and this is the premium that they just have to save to pay for claims. So this is this is part of the 25% that they keep. So they that out of that 25%, they have to keep about 50% of that 25% legally to pay for claims. And yeah, so if you take this amount out, it's actually quite a sweet balance sheet. It's pretty clean. And next thing is how do they spend investors' money? Expand grows slower than revenue, which is good, and it still managed to achieve quite strong growth with lower marketing expenses. This is one of the most important things that I was looking for. And so it's for the same quarter of last year, and the last quarter was one of the worst quarter you can get because COVID happened and everything, and they actually even reduced their marketing and they still sustain the same amount of growth, which is pretty impressive. Obviously, they missed their earning target, and that brought the share price down a little bit, but that's probably a good thing. Investing in technology development can be a good sign. So here they kind of increase their technology development costs. So some of the economic tailwinds that I know so far is the millennials they reach to a certain age, and now everyone's building family and they're building houses in the US, and the home building market is pretty hot. And people are moving to suburbs to buy houses, and yeah, obviously transitioning from a renter to a home insurance to a homeowner is, if you look at their current pricing, the renter insurance is $5, and the and the homeowner insurance is for $25. So if they one of the strategies is to manage to convert these people throughout their life cycle, and as long as they stay with Lemonade, they basically Lemonade can 5 times their revenue from a single user by their transition to a different life stage. Pet insurance is also an underserved market in the US at the moment. Expansion opportunities, they could create new products, and also, like I said, that strategy is basically to target different life cycles of the same customer and continue to increase the amount of premium they get from them over time, and increase revenue per customer, upsell, cross-sell. Most customers that they have now currently in their 20s and 30s, and yeah, so this transition will help them grow in terms of revenue, and they can roll out new markets, and it should be relatively easy for them. The only challenge is they need to deal with legal. The last thing they can do as well is to sell the software engines, which is the best asset they have right at the moment. But by the time they do that, I'll probably exit this company. Some of the risks that can potentially happen to this company is they fail to execute a deep learning strategy, which I know is if you take a wrong turn, it could go very wrong. So yeah, this is one of the risky part. And new competitors pop up. Other insurance company and VC will throw money into some of the other copycats. And by the way, Lemonade is backed by Google Venture and SoftBank. So some of so they probably won't have any problem with raising money over the long term. So that's why I haven't put that in here. And other risks could happen to this company, black swan events. We don't know what's going to happen. US economy has a bad turn. Millennials probably sell everything and move back to renting house. Who knows, right? CEO take off or smoke weed on Joe Rogan's. That could be a risk. Shareholder dilution. They need capital to grow. That's probably not the risk for the business, but a risk for the stock price. Acquired by bigger fish. So that means, well, it's usually a good thing, but to me, that's like a rip off from the current shareholder. So someone just buy you out at a lower price. SoftBank back business are having a bad name at the moment. That could be another risk as well. Well, yeah, so I really like this business, but now the next part is how much? How much is it, right? And first thing first, I usually just go straight to Simply Wall Street, and this is the fun part. And also, this is like a bonus buck for teams to look at. Obviously, you look at this like 40% undervalued, which is pretty close. But when you look at the actual calculation, you have a minus and a minus of return on equity and book value. Then you have a positive one. So this is a no. Next thing is, this is how I look at the market game anyway. So I need to find out if the current price is safe over the long term. So in the short term, it doesn't really matter 1-2 years. The stock can go up and down to like, it could go down 50%. It doesn't really matter to me. I just need to understand whether the current price is safe to enter for at least 5 years or 10 years. And each stock here has a live result. If you look at if we follow the efficient market hypothesis, well, ideally a company valuation should be a constant multiple of its earning. But in the efficient market, you have the stock price could start really high and then it's go lower and then it's go up, down over the long term. It depends on their life cycle, right? And as long as, even if I'm buying at the start of this line, it could go down. That means it's a good sign to buy more. Well, over here we have Tesla. It's an interesting one. Then the current shareholder who buying at 2,000 might be paying for is 10 years price. So next thing I would do is to look into the valuation. And if you look at this, it's this is like my best guess of their growth, and I'm using earning for this. And it's actually better to use free cash flow, but for a business with low capital expenditure like this one, the free cash flow and earning is kind of closely aligned to some degree. And I'm trying to maintain a certain margin of safety when I do this calculation. And this is, I try to estimate the fair price today and essentially my exit price as well. So if you look at the detail here, if you guys can see, is for the last year, this company has grew their revenue by 143%. So my assumption is this number are going to decline at a certain rate, and we'll go down to 100%, 90, 80, 70, 55, 40, 20, 15, 10, 10. And over this time, when they start becoming profitable and they get to a reliable state of their business, when they can have positive earning, they can maintain a net margin of 15% from the 5th year forward. And with this calculation, using this discounted cash flow as a model, is we get a fair price at about $86. But to some disclaimer here, is this fair to estimating a growth company like this share price is fluctuating extremely high. So just a single metric here change, it will shift this number drastically. That's why I created another slide. And also, yeah, to use this net margin here, I'm actually looking at some of the comparable business, like Progressive Insurance, and looking at how much margin that they're holding here. And obviously, this margin is for a company with a much higher cost structure. So I'm assuming that these guys can improve it to 15%, not the 18% that they have in their gross margin. And for this valuation thesis, this is a summary of it. I value Lemonade today at 4.8 billion valuation, in assumption that they become profitable after 3 years. They reach 1.5 billion revenue in 5 years. By year 10, they generate 4.1 billion in revenue with a net margin at 15%. And at the current value is 3.5 billion, share price $61.13, and the discount is 41%. And also one thing to note is with insurance company, well, the appropriate method to value this company is using the excess return valuation. But for this company, the model is a bit different, and they don't actually hold a massive amount of excess return. I'm not sure if they would start doing that. They will start going back to that old structure of keeping all the capital over time. But for now, this is estimating from assuming that they already paid a 75% to the reinsurer. Also, a couple of other interesting part is that we have a crappy lemonade and the best lemonade case. The crappy lemonade here is when you're assuming that their growth rate will significantly reduce at this year, and also it go down to 80, 60, 40, and it massively declined to this. So if I buy in at the current price, I will probably lose about 65% at some point. And the best case scenario is when this is another Tesla is going to manage to grow their revenue by about 50% per year from year 6. And my valuation here is about 300% gain. So that's about 4x my money at the moment. And the fair value there would be $246. And the stock price is currently going down. The reason is, yeah, analysts are bearish. Rich valuation, CEO has no track record, unproven business model, and provided low earning guidance for 2020 because the economy and uncertainty in the US market. Yeah, so after all of that, usually I wouldn't do a presentation for every single stock I buy. So this is how I do my thesis anyway. Like for every single stock I buy, I have if I buy it, I put like a portfolio icon next to the name of the stock, just to make sure that that is in my portfolio. And this is a really quick summary of why I bought the stock, and there's a bunch of other links out to other things. And yeah, so that's pretty much it. What do you guys think? And should I keep the stock or should I sell it? Or buy more?